Currently on a road trip, getting my gas, just actually got the gas, but shopping at Exxon. You know, over here in this channel, we only get our gas at Exxon because we are ExxonMobil shareholders. Big position. We really like their long-term prospects. We think that combats the anti-thesis to oil that this is an industry that's going to go away. Doesn't seem like that's going to be the case. Exxon is focusing on renewable energy. They are investing heavily in this area. Other companies based in Houston are also doing the same. They are smart. They know that the future is renewable. I'm not denying that. But Exxon has a deal with Porsche to work on lower and zero carbon fuels, which are going to be showcased at Porsche events later this year. And there's a good chance I'm going to be able to keep this car because I'm going to be using renewable, or rather, low to zero carbon fuels. So, ExxonMobil, I like them, and I'm happy to buy my gas from ExxonMobil. And this is not, you know, your grandpa's energy company wasting money, being greedy fat cats. This is a company that has adapted and adjusted to the times and is preparing for the future. And with that, let's take a look at the market and how the market is acting in the past couple of days and couple of weeks. Last week or so, we really felt like we were having a crash. There was massive selling. People were panicking. People were texting me, hey, what do I have to trim? What do I have to get out of? And really the play was just to relax and focus on the fundamentals. The notion that we are continuing to print money to stimulate, earnings are good, and more spending is on the way. So the market had a failed attempt at a crash. It attempted to crash and it did not crash. That is a good sign. That shows you that, you know, the people that needed to sell, that needed to be shaken out, the weak hands, paper hands, whatever you want to call it, got washed out. And the thesis they had didn't pan out exactly as they thought it was going to happen, as they thought it was. And that's a good thing for us bulls. And I'm still on the bull train. I think, you know, I'm not saying that a massive run is going to come. There are people who do believe that. I'm, you know, going to be a little more conservative. You know, if we were back down in March, be a little more bullish at a time like this. But we're at a much higher level. So I'm moderating, you know. I think it's going to be relatively flat, but continuing the long-term bull run. You know, markets go up. That's what has happened throughout all of history. And I'm consistent with that notion. But I do think that, you know, things will calm down a little bit because tech, which is super heavy and super expensive, is likely going to stay flat. Heavy, I mean, you know, weighting in the S&P. Likely to stay flat or cool off a little bit while other areas pick up. But I don't know if those other areas can really carry the whole market. So I think there might be a light upward trajectory. You know, Tom Lee has continued to blow the market predictions out of the water. And I say that not just because he says something like I'm saying right now, I expect, you know, this to happen. I'm taking a more soft approach. He takes a very hard approach, and I go to him for my hard research. And he's saying S&P 4,400. He's putting the number on it. Then he's saying 3,700 crash. Possibly. Who knows? We might have just gotten that. It didn't go to 3,700. It came earlier. We didn't get to 4,400. Maybe that shook out the weak hands. So we'll see what happens. But I'm giving you Tom Lee's number of 4,400, and we will see what happens. So until next time, peace out.